How should you build your portfolio to prepare for war and crisis? What are higher yielding products for conservative investors? And what if you're more optimistic and can see opportunities in any situation? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. Buy when the cannons are thundering is one way to react to war and conflict. But this advice that is often attributed to 19th century banker Karl Mayr von Rothschild is not to everyone's taste. And if you're closer to or already in retirement, or just generally more conservative and risk conscious with your life savings, you might prefer following Warren Buffett's two fundamental investing rules instead. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, we can't tell you in this video where you fall with your savings and investments and how you personally should react to the current crisis and likely market instability that will follow the strike on Iran by the US and Israel that President Trump announced just this morning. But what we can do in today's video is to give you a good framework for how you might want to organize your portfolio according to your age and risk type, from most conservative to least conservative, and which investments you may want to consider for your category, from cash, treasuries, and gold to stocks, options, and other derivatives, especially since it seems quite a number of folks in our community are planning for retirement in the not too distant future. And what you should be buying in your portfolio as you enter this next stage of life amidst the potential for geopolitical unrest and possibly lower rates is keeping some of you up at night. So with that in mind, here are the 3 topics I'll be covering in today's video. 1. What is a good, simple starting point for thinking about your bond versus stock allocation? 2. What fixed income and equity products might you consider adding to your portfolio based on how conservative or not conservative you are? And in this section, we'll also be talking a bit more about examples that don't fall neatly into either the bond or stock buckets, from simple items such as your emergency fund and principal home to more advanced products such as structured products, DPPs, direct participation programs in oil and gas, private equity, and so on. And 3. What additional factors should you consider when thinking about your overall portfolio allocation? Let's dive in now, folks. What is a good, simple starting point for thinking about your bond versus stock allocation? As you may recall from this recent video on bond versus stock allocation, we covered the rules of 100, 110, and 120. And for simplicity's sake, for today, we will assume here that we are 60 years old. According to the rules of 100, 110, and 120, we take each of those numbers respectively, so 100 here, 110 here, and 120 here, and subtract out our age, which in this example is 60, and that's the percentage of our portfolio that should be allocated to stocks, depending on which rule we use. And the rest of our portfolio, this column here, that's the percentage of our portfolio that should be allocated to bonds. Because as we've stated before, it's not just about getting to retirement. It's really all about getting through retirement. So while the allocation to bonds will increase over time, it's prudent to have some portion of our portfolio in stocks even as we age. Some portion of our portfolio allocated towards capital growth versus capital preservation. And this column here, it shows how I generally use these 3 rules as a starting point. All else being equal, I would typically use the rule of 100 for the most conservative investor, someone who wants the lowest risk and understands that lowest risk also usually means lowest return. And I would use the rule of 110 for a moderately conservative investor, someone with a moderate risk, moderate return profile, meaning they're willing to take on a bit more risk for a bit more of a return than the most conservative investor. Finally, I would use the rule of 120 for the least conservative investor, someone who's willing to accept the highest risk for the highest return, relatively speaking, of course. Now, you may have a different approach for the bond versus stock allocation in your portfolio, but in our mind, this is a good, simple starting point from which any investor can then layer on their individual circumstances, goals, and expectations. How we do it in our intermediate level bond course, Bond Masters, is this. First, we take this starting point here from the rules of 100, 110, and 120. Second, we layer onto this what we call our best model portfolio framework. Those who are in the beginning of their financial journey, those who are expanding it, supercharging it, and then transitioning out of it into retirement. Third, we add on the additional element of age. So, for example, a 70-year-old who is transitioning into retirement or even already in retirement will very likely have a different bond versus stock allocation than a 55-year-old who is supercharging savings during his or her final working years. But it's not just the allocation to bonds versus stocks that changes with your risk appetite. It's also the types of investments that you might consider within these categories, bringing us nicely to the next part of today's discussion. What fixed income and equity products might you consider adding to your portfolio based on how conservative or not conservative you are? So, let's look at what potential investment products might be a fit for which best portfolio bucket according to your risk appetite. And as always, keep in mind that you can mix and match to reflect your personal situation. For example, an investor who is not overly conservative might keep a good foundation of treasuries and investment-grade domestic corporate bonds, while gradually adding high-yield and emerging market bonds. In some cases, he or she may even be inclined to take their risks in the equity bucket only and use their bond portfolio to balance out these risks. In other words, such an investor might build a growth-oriented equity portfolio while sticking mostly to safe treasuries for the bond allocation. As our VIP Investment Club members know well, this is a strategy that I am quite fond of for our own personal portfolio. And if you're enjoying this video so far and want to learn more about our best model portfolios by age and stage of life and how to build it on your own, remember there's still a few days left to save on our first blowout sale of the year. Use coupon code INCOME2026 to take $100 off of our popular bond course bundle, which includes our foundational level bond beginners course, as well as our intermediate level bond masters course. The coupon code INCOME2026 is valid until midnight Eastern Time on Sunday, March 1st. And if you're more advanced, then come join our private VIP investment club where our members have daily conversations with me, Marcus, and one another on the best rates and what they're investing in right now for higher yields. Here's a testimonial from one of our long-standing VIP members, Tracy. Thank you so much, Jennifer and Marcus, and thank you, fellow community members. I'm learning steadily, and I can see that just following along with the concerns and questions of the group, I will broaden my financial literacy. I'm really enjoying the membership. Cheers to all. Thanks to Tracy and all our VIP members who've allowed us to share their positive feedback with everyone in our Diamond NestEgg community. And we hope to see more of you as members in our VIP Investment Club soon as well. I've included the links for our VIP Investment Club and bond courses below this video for your convenience, if you want more details. For now, let's keep going with today's video. So, as promised, here's our table of products by investor type for our Diamond NestEgg best portfolio asset classes. Here you have our best portfolio asset classes, bonds or fixed income, and stocks or equity. We've also added a separate row for assets that are outside our best core portfolio, but they may still influence your risk appetite, as well as assets that need to be analyzed case by case, as they can behave very differently depending on the situation. And let's start with the most conservative investors. Bonds for conservative investors might be treasuries, including TIPS, I-bonds, and maybe agency bonds for yields that are perhaps a tick higher. In this box, we also have CDs and MYGAs, multi-year guaranteed annuities. Yes, CDs and MYGAs are not bonds, but as our Diamond NestEgg regulars have heard me say frequently, they do often get treated as fixed income within a portfolio because their safety and predictability elements make them comparable to holding bonds. And if you don't need the liquidity or regular income stream from interest payments, MYGAs from the highest rated insurance companies may offer higher yields than CDs or treasuries. In the stocks bucket, the most conservative investors might begin with fixed indexed annuities, or FIAs, from a highly rated insurance company. FIAs allow you to participate in the upside of the equity market while minimizing the downside risk, as FIAs offer full principal protection. However, keep in mind that FIAs do not pay regular interest and/or dividends, and that the participation in the equity market upside is capped at a predefined level. If you're still in the most conservative investor bucket but can accept principal risk for an uncapped upside, you may consider low-cost funds or ETFs that follow a diversified domestic large-cap index or a broad market index such as the S&P 500. More specialized equity options for the most conservative investors might include dividend funds. In other words, funds that focus on companies that might not be growing fast anymore, but pay high and more or less predictable dividends, and funds that focus on defensive sectors such as utilities or staples, basic consumer goods that should perform relatively stably through the entire business cycle and that have historically often been less volatile than the broader index. As always, keep in mind that equities will generally have a higher risk, higher return profile than bonds, and that even dividend funds and defensive sectors may experience significant share price volatility. As for financial assets outside our Diamond NestEgg Best Core portfolio, we would expect this most conservative investor group to generally focus on cash, including their emergency fund, as well as safe and predictable lifelong income streams from Social Security, a company pension, or an income annuity from a highly rated life insurance company. Some might also have a bit of gold or other precious metals in their depot as insurance against inflation or really bad times, while others may hold a whole life insurance policy or own their family home and maybe a second property. As I mentioned earlier, these last two assets need to be analyzed on a case-by-case basis, and this is even more true for structured products. Some structured products may be attractive for this most conservative investor group, such as ETFs that offer a limited participation in the upside of the equity markets combined with a principal guarantee, similar to FIAs. However, there are other structured products out there that do take on additional risk to boost payouts or returns, and these types of structured products might be more appropriate for investors in this least conservative group. It really depends on the specific product here. Moving on now to moderately conservative investors. Moderately conservative investors can, of course, invest in the same products as this most conservative group here, for example, to lay the foundation for their portfolio. But they might also expand the products that they are looking at in order to generate a potentially higher yield, which always comes with higher risks. In the bonds bucket, they might add investment-grade munis if they fall in a high tax bracket and don't mind the generally lower liquidity. Other options here could include investment-grade corporate bonds, even though they might require a bit of extra research effort. Or, for some diversification, select developed market international government bonds from highly rated countries such as Switzerland, Germany, Singapore, or maybe Japan, as well as preferred stocks and/or REITs, real estate investment trusts. While their dividends are not guaranteed, these assets are often considered part of the fixed income allocation and used to provide an additional income stream, and some preferreds and REITs have historical track records that can be quite stable. Let's look at the equities bucket now. Moderately conservative investors might start to consider individual stocks, especially from blue chip companies. In other words, well-established, financially stable, and reputable companies with a long history of consistent performance. And if they don't have an opinion on individual companies, moderately conservative investors might expand into equity funds with value strategies that look for undervalued companies, mid and small cap indices, or again, for some extra diversification, international large cap and broad market indices. That said, if a moderately conservative investor was open to a hybrid instrument, convertible preferred securities on well-rated stocks might be an idea here. In the base case, you should be able to collect your likely, but not guaranteed, stream of preferred dividends. But in the best case, you might get some upside from being able to buy some shares on the cheap if they appreciate in value. Outside our core Diamond NestEgg Best portfolio, moderately conservative investors may consider direct real estate holdings, such as buying a house or apartment to rent out, if they have the money for it, and don't mind the very different risk profile or the management effort required. Moderately conservative investors might also want to dive deeper into structured products that offer the potential of higher yields, but with a risk overlay, as the industry calls it. For example, covered call strategies that can boost the dividends on an underlying equity portfolio, but will usually limit the upside in a strong market as well. As previously stated, structured products can be complex and need to be analyzed case by case. Moving on now to our least conservative investors. In addition to the products we already discussed, they may invest in the full spectrum of bonds that are available to retail investors, including high-yield corporate bonds, high-yield munis, emerging market government bonds, and international corporate bonds. Now, as our Diamond NestEgg regulars know, I am personally a big fan of buying individual bonds and holding them to maturity for reasons of clarity, control, and costs. But for the types of bonds that I just mentioned, you may want to start with a professionally managed fund with a good track record, unless you have the knowledge, time, and money to do otherwise. In the equity bucket, the least conservative investors might not shy away from individual stocks where they have an opinion on the company, even if it's not a blue chip, including mid and small caps, as well as international stocks. And if picking individual stocks is not what you want to do, growth equity funds or more narrow sector, industry, or theme funds might add some extra returns against some extra risk, as always. For example, classical tech, biotech, or country funds come to mind. Outside the best core portfolio, having a higher risk appetite may open the doors to many additional investment opportunities, so to speak. Just don't forget the higher risk if you want to actively engage in a business venture or take a passive stake in an entrepreneurial venture, such as a DPP, direct participation program in oil and gas, a venture capital fund, or a private equity investment vehicle. Investments may carry higher risk as well in crypto, hedge funds, and derivatives and options that are usually meant for short-term speculation. And there are many other alternative investment ideas out there, as the industry calls them, including works of art and other collectibles. The least conservative investors might also be open to more aggressive or high-risk structured products. But once more, the universe of structured products is big, and this would need to be analyzed on a case-by-case basis. And if you're enjoying today's video so far and want to keep learning to gain the know-how and confidence you need to build and manage your own bond portfolio, use coupon code INCOME2026 to take $100 off of our popular bond course bundle and VIP Investment Club membership before midnight Eastern Time on Sunday, March 1st. Our bond courses are the first step in learning all about fundamental treasury, agency, corporate, and municipal bond concepts and how to build a bond portfolio. And our VIP Investment Club allows you to advance beyond that and dive deeper with me, Marcus, and other members. Visit www.diamondnestegg.com or the links below this video to learn more. And let's move on now to the next part of today's discussion. What additional factors should you consider when thinking about your overall portfolio allocation? Now, let me add 3 comments that are valid across all types of investors, regardless of their risk appetite. 1. Core assets under our best core portfolio usually have a market price and are reasonably liquid, which means that you should be able to easily buy them and check on what they're currently worth, often simply by logging into your brokerage account. You can often readily convert them into cash by selling them or by offering them as collateral for a loan. And not least for these reasons, these core assets often form the main part of the retirement assets for many Americans. Assets outside the best core portfolio, on the other hand, and especially so-called alternative investments in the narrower sense, including private equity, venture capital, hedge funds, and DPPs, may not be very liquid and can sometimes be hard to value. You may not always know what they're currently worth, and you might have to wait longer and or accept a worse price than you expected when you try to sell them. For example, because you need the cash. And for this reason, the industry has developed several rules of thumb on how much alternative investments should be in your overall assets. They're not all the same, but if I was to summarize it in my own words, maybe 0 to 10% for very conservative investors, 5 to 15% for moderately conservative investors with a larger portfolio, and still not much more than 30% even for private investors with the largest portfolios and the highest risk appetite. So, if that's an area that might be of interest to you, keep your eyes open, but always make sure you understand the investments you're buying, which has been a consistent theme of our courses, our VIP investment club, and our YouTube videos. 2. Keep in mind that the classification of an asset should always be driven by its fundamental underlying risk profile and not by any label or packaging. So, for example, both individual bonds and bond funds would be considered a part of the fixed income allocation. And 3, we generally would not include a primary residence as well as any vacation home on the side as an asset for purposes of our best portfolio planning. That said, this might be different if an investor was planning to downsize and sell these homes when retiring, or use the equity in these homes to finance his or her retirement, for example, by taking out a reverse mortgage or using a similar technique. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And remember, there's still a few days left to save. Use coupon code INCOME2026 to take $100 off of our popular bond course bundle and VIP investment club membership before midnight Eastern Time on Sunday, March 1st. Visit our website at www.diamondnestegg.com or the links below this video to learn more. And see you again very soon with more brand new wealth building content for your financial journey.